what they say, a penny saved is a penny earned. If you truly believe this quote, then you have got to hear what we're about to share. Hello everyone, we are finally back with the second season of Insurance Insights podcast by Policybazaar. We know you've been waiting for this. But before we dive deeper into what's in store for you this new season, we'd like to thank you for your love and support during the last one. But it's time for something even bigger and better. We've designed this new season keeping in mind the ever-changing insurance landscape in India. And yes, we know, understanding insurance concepts can be a little intimidating, but we are here to change that with the help of our experts. So fasten your seatbelts and enjoy this ride. Now before we begin today's episode, let's jog your memory a little. Do you recall the several changes introduced in the personal and direct taxes in the Union Budget 2023? Whether you're a newbie or a seasoned investor, there's one change that you should definitely be aware of and act upon right away. The Finance Minister announced the removal of tax exemption on income from traditional life insurance policies where the annual premium is above 5 lakh rupees. But what many people don't know is that investment in traditional life insurance policies where the annual premium is below 5 lakh rupees is still tax-free. But not for too long. To help us understand this better, we have with us Sameep Singh, who's the business head of savings and investment at Policybazaar. Welcome to the show, Sameep.
Hi, Simran. Hi.
It is common for investors to go merely by the rate of return that they see on an FD, RD, or MF. But I think it's equally important to factor in the taxes that they will pay on those returns. Can you please elaborate on that?
See, when you talk about taxation, the most important thing that comes to my mind at least is that government recently changed tax guidelines once the budget was announced. So trad plans up to 5 lakhs are tax-free. Above 5 lakhs, they became taxable. And ULIP plans also up to 2.5 lakhs are tax-free. Above 2.5, they are taxable. The ULIP part, the tax guidelines changed in February 2021. So in insurance, up to 7.5 lakhs, you can claim as tax-free returns. So if you invest every year 7.5 lakhs annually, the maturity would be tax-free. In no other competing instrument like FDs or debt mutual funds or equity mutual funds for that matter, all are taxable upon maturity. So this is an exceptional tax arbitrage that insurance plans offer that no other competing plan offers. For example, if I take a trad plan or guaranteed return plans, as I might say, they invest so I invest 40,000 rupees a month, which is less than 5 lakhs annually. And that comes out around 4.8 lakhs. I do that for 5 years, so I pay for 5 years and I stay invested for 10 years. Now the maturity amount that I would get would be around 41 lakhs, assuming a 7.5% rate of return, which is also very good. And see, if you get the same return in an FD or a debt mutual fund, there you would have to pay tax on the 41 lakhs return. So your net gain that comes out is around 17 lakhs. On the 17 lakhs, you would pay, if you're in the 31.2% tax bracket, you would end up paying around 5.5 lakhs as taxes. So this is a huge amount that in other instruments like FDs and debt mutual funds, you would pay as tax, whereas in a guaranteed return plan, you would escape that taxation. So that is why traditional plans, traditional endowment plans or guaranteed return plans up to 5 lakhs are a very good investment option. You get tax-free returns. The rate of return also currently offered by some of these plans are up to 7.5%, which is by far the highest in the market. See, FDs offer 7.5, some offer 8% also, but these are taxable. So the net return that you get in an FD or a debt mutual fund would be around 5.5, 5.6% post-taxation. So these beat that by a good 1.5%, 2%. And these returns are at a peak right now. Currently, government bond yields, which are the basis of these plans, are trending around 7%. So the rates are supposed to get revised in this month or in the next few weeks. So if you don't lock in your returns now, you would miss out on this opportunity. That's the other big thing that you need to keep in mind. You get two dual benefits. You get exceptionally high returns, 7.5% tax-free, and obviously you get maturity that is tax-free. So a double benefit option is there.
If one is looking for best possible returns with minimum risk involved, can you suggest some investment tools that they should consider?
See, guaranteed return plans, they give you on a bond paper what is the return that you will get. So if I'm getting around 7.5% upfront, that will be written on a piece of bond paper that this is guaranteed and in no way will in the future upon any circumstances this will change. So there is absolutely no risk associated with them. So customers who invest in FDs, this is an extremely good alternative. See, you should keep some money in FDs for liquidity reasons because these are slightly less liquid. But keeping the remaining spare money that you have in FDs and the rest in a guaranteed return plan makes very good sense. Low risk, exceptionally high return, 7.5%, almost 7.5 that you get. Now moving away from that, the other thing that people can choose to invest in, if you are slightly oriented towards equity investments, you can choose capital guarantee products, where this kind of capital guarantee products or solutions that we have built is a mix of an endowment or a traditional plan and a market link plan. So you get market link returns also, plus you get the benefit of security of principal. So whatever you have invested, if I invest suppose 1 lakh rupees a year, and I do that for 10 years. So if I've invested 10 lakhs over the course of the premium payment term, that money is guaranteed. So I will always get my principal back, plus I get market upside. So for people who are, do not want to take too much risk, guaranteed return plans, the first option, or they can choose for, if they want a slightly equity exposure, they can choose for capital guarantee plans.
So Sameep, for female investors, are there any investment tools that offer additional maturity benefit compared to male investors?
The plan that I was talking about, the Max Smart Fixed Return Digital Plan, this plan specifically gives additional returns to female customers. So if you choose a 10 policy term, if you have a 10-year tenure of the plan, then you get 0.5% extra from what a male would get of the same age. And for a 5-year policy term, you'll get 0.25% extra. So for females, it makes a lot of sense to get additional returns by investing in this product. And for male customers also, if they want to take benefits of this plan, they can buy for their wives, they can buy for their children, and get take benefits of the additional return.
Okay, thank you for explaining that, Sameep. For someone in their early 30s wanting to build a sizable corpus for short-term goals, can you suggest some insurance cum investment products for them?
See, short-term goals, so the first thing that comes to my mind is that wealth is not created with short-term investment horizon. So if you genuinely want to create wealth, you should have a slightly long-term horizon, at least more than 5 years. Because in 1 to 2 years, a plan would give you 10-12% rate of return, and that's also a very good rate of return to get. But if you invest 1 lakh rupees, you will just make around 1,12,000 or 1,24,000 in 2 years. So that is not a substantial amount of money to that will make you really wealthy. So you should have a slightly longer horizon. But if somebody still wants plans that give money in the short term, there are immediate income plans also, where if you start today, maybe if I start at 10,000 rupees a month, and I would start getting an income from the next month onwards. So I get 4,000 rupees as income. So I pay 10,000 for the next 10 years, and I start getting 4,000 rupees every month from the next month onwards for the next 30 years. And so by the end of the 30th year, I've almost got 4x or 3x of what I've invested. So that's a very, very lucrative option that a lot of people choose. How that helps is that you invest 10,000, and the 4,000 that you get, you can start an SIP with that, or you could give that as pocket money to your kids, and that money has a separate source, and you know that this will keep coming to me for the next 30 years. So immediate income plans are the other thing that you can consider for short-term wealth. But if you at least have a 5-year horizon, I would suggest you could do market link investment plans called ULIPs. If you just have a 1 or 2 year horizon, then mutual funds are the option that you can go for. But serious wealth creation will at least take 5 to 10 years of time horizon. In the short run, 1 to 2 years, mutual funds will give you 10-12%, but that will never generate substantial wealth.
So Sameep, I've seen that nowadays there are investment tools that also offer joint life coverage. Can you throw some light on that for our listeners?
Joint life plans, personally, what I associate joint life plans with are annuity plans. Now, annuity plans are relevant for people in the 45 plus age group, where they want income for their post-retirement years. Now, for them, a joint life plan where they are covered and their spouse is also covered makes a lot of sense. Why? Because once you retire, you have a lump sum corpus, you invest that, and you get income. And that income you will get first, and then once the primary annuitant or the person dies, then his wife or spouse would get that income. So both are covered and both get benefits of that income. Apart from that, if you do not have a corpus and you are in a 45-46 year age group bracket, then you can invest monthly also and buy a joint life plan. So the income that you will get upon retirement will again be given to you first, and then post that to your spouse. So in that scenario, I think joint life plans make a lot of sense. Apart from that, joint life plans are purchased when you buy term plans, where term plans meaning you have a life cover. In case of death, the life cover gets paid out. Otherwise, you don't get anything. Now, in these scenarios, joint life plans used to be bought, but what I would suggest now is that you keep both separate. And so instead of buying a joint life plan, you buy a standalone term plan for yourself and for your spouse. You can buy a different separate standalone plan, and if she's non-working also, then also you can get a standalone term plan for her, so that both plans are separate and the covers run parallelly for both of you. So primarily the joint life annuity options are the ones that make most sense.
Thank you, Sameep, for such a detailed explanation. I found it really insightful. I'm sure our viewers feel the same. Now, moving on to our next segment, Ask PB, where we take questions from our listeners about insurance, investment, and solve their queries. So today's question is from Prabhakar. He's asking, I just turned 25. Would now be a good time to purchase a life insurance plan?
See, somebody who is very young, I think 25, he just started earning, that is actually the right time to buy a term life cover. See, term life plans basically offer a death benefit. So if you buy a plan and you buy it for a 40-year tenure, if something happens to you in those 40 years, the family, your dependents get the life cover. So if a 25-year-old buys a 1 crore life cover, he would get it for 500-600 rupees a month, which is extremely low cost. So the younger you buy it, the cheaper it is. If you buy it at 40 or 50 years of age, it will be extremely expensive. Plus, you might not get it also because there's a physical medical that gets conducted during the term plan issuance, and you might not get it if you have any pre-existing diseases. So that is the first bit where a term plan makes a lot of sense. The other thing that younger customers should definitely focus on is health plans. Now, the earlier you buy a health cover, even though the premiums will increase, in term plans, the premiums do not change. Once you buy it, the premium remains the same throughout. In health plans, the premium would increase, but the pre-existing diseases, they get covered after 3 to 4 years. So the earlier you buy it, the quicker the pre-existing diseases would get covered. And for younger customers, I would also like to highlight one last point from an investment perspective, is that the earlier you start saving, the quicker your corpus will grow, right? So if you start at 25, you will have 35 years for your corpus to get built up. If you start at 35, 40, you keep delaying it, the amount of money that you need upon retirement remains fixed, right? You would need 3-4 crores at least. So the earlier you start, the longer you will have to let the money grow. Power of compounding comes into effect, and you get a bigger corpus.
Thank you for explaining that so well, Sameep, and thank you so much for being on the show.
Thank you.
With this, we have come to the end of today's episode. Thank you so much for tuning in, and please do not forget to like, share, and subscribe. If you have any queries related to insurance or investment, please feel free to write to internalcommunications@policybazaar.com. We'll be back with another informative session soon. Till then, stay safe and keep making smart insurance decisions.